Ironically, quite a few commodity companies are among the best performers in China this year, and the list includes energy. Quite a few coal producers, such as Zhongjin Gold, China's second biggest producer of the precious metal. Our next guest manages $300 million, including a diversified commodities fund, which has beaten its benchmark for the past 10 years, posting an 11% annual return, according to its latest fact sheet. Greg Smith is a founder and executive director of Global Commodities and joins us now in Singapore. Good to have you with us again, Greg. First up, to the G8 summit, where leaders warned of this fragile recovery and that it was too early to reverse the stimulus efforts. What sort of a bearing do you think this is going to have in commodity markets in the long run?
Yeah, good morning, Kathy, and thank you for having me. I think in the long run, the big picture hasn't changed. Effectively, we are consuming. We continue to consume, and if they are expecting higher GDP growth, there is a direct correlation to increasing GDP and resource consumption. And it's also interesting but understandable to see in your last article that a lot of the commodity companies that are going sharply higher in China. And it's only a matter of time before these markets will start to balance out and then start to head higher again.
Okay, people are consuming, but are they consuming as much in this global recession? When you look at the Reuters Jefferies CRP index, it's fallen more than 10% from its year-to-date peak in June. It makes people think that it's already had its run.
Well, the interesting thing about commodities is they move sharply higher as a function of supply disruption. If we keep that as the basic foundation and premise for achieving a return over time, what we've seen is not so much supply disruption, Kathy, but a realignment of the US dollar. As the US dollar weakened, there was a lot of capital that moved into the commodities as a way of hedging against the declining US dollar, because most commodities are priced in US dollars. So what we saw in the run-up was speculative money predominantly. And over time, though, that will balance out. And indeed, at these sort of levels, we're not, I think it's probably not a bad time to start seriously looking at getting into the commodities if you aren't already in them.
Well, yeah, 30% of your fund is in commodities, but not really everything. I mean, 70% is in cash. Given the predictions you've got, are you going to be increasing your positions in commodities then?
Well, we do it as a function of seasonalities, price action, forward curve behaviour. And because the price has come off, that's been dominant. So, yes, we have been reducing our exposure, and we can get down to as low as 20%. But at these levels, when you think about it, we've been doing this for nearly 10 years, the risk, the downside risk is really quite limited. We've got 30% sitting in commodities, 70% sitting in cash. Now, why is that? Well, you've seen the price action drop sharply. Now, a lot of these markets, I believe, are oversold, particularly the grains. But I think we're going to talk about those a little bit later. But at the moment, one of the reasons why we have performed as well as we have over the last 10 years is managing the downside. It's the only thing you can quantify, Kathy. It's the only thing you can quantify is how much you're going to lose if you're wrong. And so we focus on that. And by default, we generate a return by not losing as much. And so that's what we're focusing on. But what I'm saying, at these levels, we don't often see 30% exposure to commodities. We tend to sit around 50%.
So what's going to happen to that exposure? You got 70% in cash by the end of this year. How is that going to look? Is it going to, are you going to be fully invested in commodities given the opportunities?
We could be, but it's a function of price action. It's a function of weather. It's a function of the behaviour of the forward curves. But I think by the end of the year, you'll see higher prices in sugar. You'll see higher prices in oil. You'll probably see higher prices in gold as well. I think at these levels...
Well, let's talk about oil and gold because, Greg, you did mention about the dollar and prices in oil and gold are extending gains because the dollar slipped against the majors. Oil trading well above 60 a barrel as we speak. It's oscillated in both supportive and negative factors, hasn't it, when it comes to oil? What does your strategy tell you about its outlook?
Well, we still hold our core positions, Kathy, and we will probably hold those down to around $50 a barrel. But I don't think we will see $50 a barrel again. If we do, a good opportunity to start buying again. What amazes me at the moment is that you mentioned earlier demand destruction. Well, we're talking 2 or 3%. It's, in the scheme of things, it's a rounding error. If demand was down 30, 40, 50% equivalent to the price, well, yeah, then I'd be more concerned. But the demand, if you think about it, the variability in demand is low compared to the variability in the supply disruptions. And so what happened, or into the supply. And so you've got this constant demand, and it fluctuates maybe 2, 3%, but it's not a big number.